Over the past couple of years, I've been speaking about the importance of having a well-balanced portfolio of both equities and fixed income positions based on your risk tolerance, your age, your time horizon, and your goals as an investor. And in today's video, we're going to be looking firsthand at why that's of such importance. Hey, what's going on, savers and investors? As always, I hope you're having a great day and that you get to enjoy some time off during Easter break. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be speaking about a topic that honestly hasn't really got any attention whatsoever on YouTube from other YouTubers or even myself for that matter during this whole stock market crash, but is nonetheless an extremely important element of having a well-diversified portfolio, and that is having a proper allocation to fixed income positions, so bonds and bond ETFs specifically, in order to weather through all economic cycles as we're experiencing right now. I know for a lot of investors and viewers, the idea of investing in bond ETFs can be pretty boring and isn't nearly as fun and sexy as investing in the newest hot tech stock. And honestly, I get it. I'm not going to sit here and say that I'm a huge bond investor and that they comprise a large portion of my portfolio. However, as someone who wants to continue investing in the stock market for at least 30, 40, 50 years ahead, well, I know that I'm going to be living through at least 4 to 5 more recessions during that period of time. And for this reason, I recognize the importance of having a well-diversified portfolio of stocks, bonds, REITs, and various ETFs based on my investor profile and my goals as an investor. And if you're watching this video right now looking to create your own stock market portfolio, or if you're looking to rebalance a current portfolio and you don't necessarily hold any fixed income positions right now, then hopefully this video is going to help you better understand why it's a wise choice to do so. So in today's video, we'll first be covering the typical benefits of holding fixed income in your portfolio in the first place in relation to a well-diversified mixture of assets, and then also be looking at how bonds work and fluctuate in the market, how their price fluctuates throughout time. And then following that, we're going to be looking at a real life example of a comparison of equity versus fixed income performance right now in the market. If at any point in today's video you're enjoying the content and it's providing you value, then please take 2 seconds to smash the like button. And before going any further, if you're accurately looking to track your dividend income, stock market portfolio gains, as well as your budget and net worth, then make sure to check out the ultimate stock market spreadsheet that I made just for you down in the description. The response as of now from users who have purchased the spreadsheet has been extremely positive in the community, and the spreadsheet is going to help you accurately keep track of all your finances and stock market returns all in one easy and simple to use spreadsheet. Alright, so with all that out of the way, let's first and foremost dive into what bonds even are in the first place, because for many new investors, the concept of how bonds and fixed income positions work and how their price fluctuates in the market can be quite confusing. So quite simply, a bond is a debt obligation between two parties. The first party being the issuer of the bonds, known as the borrower, and then the investor who's picking up those bonds in return for an interest payment, which is known as coupon payments with bonds. This is the main reason why you may have heard investors refer to bonds as fixed income before, because bonds provide your portfolio with steady and predictable interest payments issued by the issuer of those bonds. Think of a bond as sort of the opposite of when you go to the bank requesting a loan in order to finance one of your projects. Well, in this scenario, the bank is the issuer of funds and you would be the borrower of funds who's looking to receive that money, and in exchange, you need to pay out interest payments to the bank for lending you their money. With a bond though, it's the complete opposite, where a government or corporation is looking to raise capital in order to fund certain projects, so they're going to issue out bonds to the general public so that all investors can pick up those bonds, essentially lending them money, and in return, the investor, which is you and I, is receiving coupon payments, which is basically the same as interest payments. Now, I do want to mention that we could get way more technical here, so if you want to see a more technical video about bonds and fixed income relating to what a bond even is, then let me know it down in the comments. However, for initial comprehension, this is essentially what a bond is. With this in mind, you might be thinking to yourself that this sounds relatively similar to the interest payments that you're receiving in your high interest savings account, and this isn't necessarily a false assumption, because banks are essentially paying you out interest when you put your money in their high interest savings account so that they can use your funds in order to go out and invest and get a higher return themselves. However, the fundamental difference between these two things is that bonds are publicly traded financial securities that are traded on exchanges just like stocks and other financial securities do, and so for this reason the price can fluctuate as they're traded throughout the day. And although there are many many elements that come into play regarding why the price of bonds fluctuates. The main reason is the underlying interest rate of the economy, and as we can see here from these two graphs, the interest rate in both Canada and the United States has significantly dropped over the past couple of months as these federal governments are trying to stimulate the economy. And in fact, if we even look at a longer picture here, the interest rates have significantly dropped over the past couple of years or so. To keep things simple, generally speaking, when the economy enters a sell-off period, as we've been experiencing over the past couple of months, the feds will cut interest rates down to a lower rate, making borrowing money much cheaper, with the hopes of individuals and companies taking advantage of these lower rates and then stimulating the economy by reinvesting back into the economy and growing their operations. Let me try to make this as simple and concise as possible for you. So a bond has what's known as a face value, which is the price the bond was initially sold for and is the amount of capital that the bondholder would receive back if they were to hold the bond until the end of the term, which is known in the bond world as the bond's maturity date. A bond also has a coupon rate, which is the dollar amount paid out to the bondholder each year for holding the bond, which then translates into a coupon yield. This is sort of the same as dividend payments from companies, except the bond issuer has the obligation of paying the coupon. They don't have the choice as companies do with their dividends. For example, if a 20-year treasury bond had a face value of $1,000 and paid out an annual $100 coupon, the coupon yield would be 10%. If the same bond went up in value to $1,333 in the open market, the coupon would remain the same at $100, but the coupon yield would drop to 7.5%. Now let's say in this theoretical example that the underlying interest rate of the economy dropped down from 10% to 5%, and newly issued treasury bonds at a $1,000 face value were now only promising a $50 coupon payment equal to a 5% coupon yield. Well, this makes that first bond at a $100 coupon payment and current 10% yield much more attractive and in demand to investors. And what happens when there's more demand for something? The price goes up. Typically what happens with bonds is that the price will go up until that first bond would reach a yield equivalent to the prevailing interest rate environment, which in this case is 5%. So the $100 coupon bond would rise in value to $2,000 in order for the $100 coupon to be equal to a 5% yield. I really hope that this wasn't too confusing to you, and if it was, make sure to watch it a couple times over, and if you have any more questions, leave it down in the comments. I'll make sure to answer with as much detail as possible. With that in mind, the economy's underlying interest rate is by far the largest element impacting the pricing of bonds in the open market, making them somewhat the opposite of interest rates, where when interest rates go up, bond prices go down, and when interest rates go down, bond prices go up, as we're experiencing right now and we're about to see visually with a couple examples. It's really for this reason that it can be highly strategic to hold both fixed income positions, so bonds or ETF bonds, as well as equity positions in your portfolio with an allocation based on, once again, your age, your time horizon, your risk tolerance, etc. And the reason for this is so that you're not overly exposed to equity positions exclusively if and when you enter a recession, as we've just experienced right now. And this can have a high impact on your portfolio, taking a huge hit if you only have equities in your portfolio. Now, if you had a portion of fixed income in your portfolio, this would help average out your returns during all economic cycles, as well as provide your portfolio with fixed income payments. This is why I've mentioned in previous videos that older investors who might be approaching retirement in the next 10 to 20 years might want to focus more heavily towards fixed income positions, maybe even in the 50 to 60% range relative to equity positions, because this is going to provide your portfolio with those fixed income payments, and generally speaking, fixed income is going to be less volatile than equity positions. And then on the flip side, as a younger investor such as myself, for example, I am much more bullish on equities because I have the time horizon to ride through recessions that are inevitably going to come during my investing career. And so for this reason, I'm only allocating 10 to 20% in fixed income positions. To tie all of this back to what's currently happening in the stock market, well, bond yields have fallen quite sharply recently as the federal governments have cut interest rates down to all-time lows. But as we just learned, with new bonds coming out with a lower coupon payment, this means that the coupon yield is significantly lower than what you could currently get in the bond market. So for this reason, due to the fact that existing bonds pay a much higher coupon, so the market is trying to equalize the bond yields by raising the price of those existing bonds with a higher coupon payment so that it now equalizes the underlying interest rate of the economy. Now, historically, the interest payments received for holding bonds has been a much more predominant factor in the overall returns of your bonds. However, in recent times, the price of bonds shooting up has pretty much entirely encompassed the returns of your bonds. Let's take a look at some real-life examples of current bond ETFs in the American market relative to equity ETFs such as the S&P 500 and the NASDAQ 100. So in this graph, this is a year-to-date comparison between SPY, which is an S&P 500 ETF, as well as QQQ, which is the NASDAQ 100 ETF, and then three bond ETFs, the first one being TLH, which is the iShares 10 to 20 year Treasury bond ETF, followed by TLT, which is the iShares 20 plus year Treasury bond ETF, and finally, the last ETF is ZROS, which is the PIMCO 25 plus year zero coupon Treasury bond ETF. Now, first off, I would like to mention that these three bond ETFs pay either no coupon at all or the coupon yields has dramatically fallen. But in terms of asset prices, if we compare their year-to-date return to the two equity ETFs, the results are pretty staggering and clearly demonstrate what we just covered in this video and why it's important to hold equities and ETFs in your portfolio, as the bond performance is quite literally the opposite of interest rates, as we're visually seeing right now. As always, it's difficult to predict where interest rates will be heading in the coming years, but by looking at a chart of the interest rates in both Canada and the US here over the last decade and considering the current economic climate, there's really no sign of increasing interest rates anytime soon, which is a positive thing for bond prices. So really the goal of this video was to allow all the investors who watch my content to visually see the importance of holding fixed income positions in your portfolio, as I've been speaking about over the last 2 years or so of making investing related content, because even though I've mentioned this multiple times throughout my videos over the past couple of years, I think that this was somewhat overlooked by many investors because it's much more exciting and enticing to want to invest in stocks and tech stocks. However, we're living through a period right now where owning a portion of fixed income would have highly offsetted the losses of your equity positions. And if you're truly an investor who's looking for long-term steady gains, as I try to teach you guys on this channel, then it's really important to have a portion of fixed income based on your risk tolerance and investment horizon. And this isn't to say that during this stock market crash, you should not be doubling down on your equity positions. It certainly is, and that's one of the reasons I've been focusing so much on equity positions in my most recent videos. However, this was really just to showcase what I've been speaking about over the past couple of years of the importance of holding fixed income in order to hedge against some of your equity losses during a recession, which from a psychological standpoint can be very positive for many investors. I'm really just trying to give all you investors who watch my content a wholesome view of stock market investing and trying to think of your investing as a long-term play rather than exclusively short-term gains. So what did you think of the topic of today's video? Do you hold bonds in your portfolio, and what is your asset allocation towards fixed income positions? I'd love to know. Leave me a comment down below, and if there's anything that you didn't understand in today's video, then don't hesitate to leave your questions down in the comments. I'll make sure to answer every single one with as much detail. So if you enjoyed the video, make sure to smash the like button and consider subscribing to the channel. We speak about everything related to stock market investing and personal finance. And if you want to learn more about investing in the stock market, then make sure to check out one of the 2 videos that I'm overlaying right here. So on that note, thanks a lot for watching, and I'll see you in the next video.